This LOS is Compare Share Repurchase Methods. Share repurchases. A share repurchase or buyback is a transaction in which a company buys back its own shares. Unlike stock dividends and stock splits, share repurchases use corporate cash. Hence, share repurchases can be viewed as an alternative to cash dividends. Shares that have been issued and subsequently repurchased are classified as treasury shares, treasury stock. Or in some jurisdictions, the shares are retired or canceled. In either case, they are not then considered for dividends, voting, or computing earnings per share. So that's two important points that I've put in bold. Share repurchases use corporate cash. They're classified as treasury shares, and they're not paid any dividends, given any voting rights, or computed in the earnings per share calculation. And you remember that from our earnings per share LOS, you have to deduct the number of treasury shares. That's important. So think credit cash and debit treasury shares. They are debit entry in the equity section. We're going to decrease cash and we're going to decrease equity, and that's going to affect all the associated ratios. Share repurchases. So now we're going to look at the repurchase methods, and there's four here. So the first one is just to buy in the open market, and this method of share repurchase is the most common. So the company's got some cash, they just go out and they buy shares in the open market, okay? Just like any other investor, except that the issuer of shares, so it'd be credit cash, debit treasury stock, and it's not going to receive a dividend, there's no voting right on those shares, and not being considered then for earnings per share calculations because it's treasury stock. The second method is to buy a fixed number of shares at a fixed price. So sometimes a company will make a fixed price tender offer to repurchase a specific number of shares at a fixed price that is typically at a premium to the current market price. So people would be motivated to sell their shares back to the company because they're getting some type of a premium. The third is the Dutch auction, okay? And I've seen many questions with regards to the Dutch auction. Love the Dutch auction. It's in the glossary, so have a look at it. A Dutch auction is also a tender offer to existing shareholders, but instead of specifying a fixed price for a specific number of shares, the company stipulates a range of acceptable prices. Okay, that's the key point there. The company stipulates a range of acceptable prices. A Dutch auction uncovers the minimum price at which the company can buy back the desired number of shares with, the company paying that price to all qualifying bids. So a Dutch auction is set a range, and then it discovers through the number of people indicating at which price they would sell their shares back, the minimum price that the shares that the price is going to pay to all qualifying bids. And then finally, the fourth method for share repurchases is repurchase by direct negotiation. In some markets, a company may negotiate with a major shareholder to buy back its shares, often at a premium to market price. Okay, I'm just taking a quick screenshot of my computer. I'm in the ebook and I'm in the glossary, and I've said this before and I've said it again. I think it's really important that you copy and paste and print out the glossary and just get familiar with a lot of the terms, because the CFA Level 1 exam, a lot of it is English test, subject accounting or ethics, or in this case, you know, what is a Dutch auction? If you're just reviewing through the glossary as a review document, you can see a Dutch auction is an auction in which the auctioneer begins at a high price, then lowers the called price in increments until there's a willing buyer for the item being auctioned. So with regards to the share repurchases, they set the range. People submit the price at which they're comfortable to have their shares bought back, and that determines the price that the shares are, you know, for the amount of shares at which price, okay? And you can see there is something that wasn't even mentioned in the text. Dutch book theorem is a result in probability theory stating that inconsistent probabilities create profit opportunities. So I don't even know where that is in the text, but just wanted to point that out, that there's a lot of terms in the glossary. Some you should be familiar with, some are pretty interesting. Up there at the top, DuPont analysis. Again, that's an approach to decomposing returns on investment. We've seen a lot of that. Duration, the duration gap. So again, the glossary is a very important document to be familiar with and to go through those terms and be familiar with everything in the glossary. Okay? We're just going to finish this LOS with a practice question. A company has positive free cash flow and is considering whether to use the entire amount of that free cash flow to pay a special cash dividend or to repurchase shares at the prevailing market price. Shareholders' wealth under the two options will be equivalent unless the A, company's book value per share is less than the prevailing market price, B, company's book value per share is greater than the prevailing market price, or C, tax consequences and or other information content for each alternative is different. Okay, the correct answer is C. For the two options to be equivalent with respect to shareholders' wealth, the amount of cash distributed, the taxation, and the information content must be the same for both options. So in A and B, company's book value per share really has nothing to do with the shareholders' wealth, okay? The shareholders' wealth is just with regards to the number of shares that they hold, and they got a dividend or they got they sold their shares back, okay? Because in certain jurisdictions, dividends are taxed differently than capital gains. And when I sell my shares back to the company, that might be a capital gain and not a dividend, okay? So it all depends on the amount of cash distributed, the taxation, and the information content. And that is the last slide for this LOS. Thank you.